Well, rest in peace. And press F in the comments to pay respect to the fallen meme stock tattooed chef. They have finally been delisted after announcing that they were going to be filing for bankruptcy protection. So it is now only available on the over-the-counter markets, and I figure now is a good time to do a little bit of an autopsy on this and provide the lessons learned on this whole ordeal. So I never put a penny into Tattooed Chef, luckily, but I know of many people who have. Many people who used to follow Jeremy Financial Education Guy, and a bunch of others that maybe thought that plant-based food is the future and everything. And hey, on a long enough timeline, it very well may be, but there are some things we can take away from this. There's some Warren Buffett nuggets of wisdom that maybe apply to this situation that I would like to just share with you briefly. So the reason people got in the first place, I get it, right? It was a newly publicly traded company a few years back. They were posting up insanely good, attractive looking revenue growth. Early on, there were points where they were gap profitable, but always had negative free cash flow. So that's a concern. So like when I'm looking at companies, if they are always negative on their free cash flow, but never gap positive on their, or they're gap positive on their earnings, but never positive on their free cash flow, that's like a little bit of like a red flag. On a long enough timeline, you would like to be able to add up the sum of their free cash flow and the sum of their earnings and come up with numbers that are like sort of comparable. Like it's never, I don't think it's ever really going to be like exact in most cases, but you would like there to be some kind of relationship between the two numbers. They can be temporarily wonky for a lot of different reasons because of like accrual accounting and the way like CapEx is depreciated over time, but it costs you cash up front and that kind of thing. But it's just a little bit of a worry because like not once, right, did they have a year with positive free cash flow, but they were, gap positive to the point where I think that maybe got people pretty excited. This is probably what people use to justify the 20 something dollar share price at different points. But here's the problem. All right, this revenue growth, nobody knew if it was going to be sustainable or not, and it was paired with substantial share dilution. Okay, so even if they had kept the same amount of net income, the EPS would have fallen in half because of the 100% dilution the next year. Like that's insanity. And honestly, the gross margins, I understand why people might have thought, hey, after 16% and then 15%, they might have thought it would stay consistently in the mid-teens range. But by this point, by the point where it fell to like 8%, you should for sure have been concerned that they couldn't maintain their gross margins. Either their supply chain isn't great, or commodities prices for some of their, if any of their ingredients relied on certain commodities. That's a big concern. Okay. Now, the problem here is also the cap on the market size, right? So people may have wrongly also assumed that revenue growth in this 75 to 80% range would have continued somewhat, or it maybe would have fallen more slowly than it did. But the fact of the matter is, this plant-based thing, like vegans make up roughly 3% of the market, all right, the potential market for frozen food. And the big mamma jamma in the frozen food space that's like that sells meat-based products, I would argue, is Tyson Foods. And so we have to ask ourselves, if they got to their maximum scale, which I would think would be somewhere in the neighborhood of 3 to 5% of what Tyson does, And even if their gross margins stayed in the, the low to mid teens, would they have been profitable enough to spit out a good return for people who paid, $15, $20, $22, whatever it was when people were getting most excited and getting into this stock? That's a tough sell for me, okay? Because Tyson Foods has massive, massive, massive scale, okay? And that's how they keep their gross margins a little bit more consistent, because they have the efficiencies of scale, they have pricing power and things that little tattooed chef probably would never have gotten at the size I think they reasonably could have gotten to in terms of their revenue. So the writing has really been on the wall that this was, at the very least, a speculative and risky investment. And for a good chunk of time now, the writing's probably been on the wall that they were heading towards bankruptcy. Okay? So Warren Buffett has this philosophy of not making investments that have the potential risk to take you out of the game. So imagine you've got like $1 million in investable capital to put into something, and you do what Jeremy did and you throw it into something like Tattooed Chef, and then what happens? What happened ends up happening. That will, at the very least, it will set you back years, if not totally take you out of the game. All right, and you don't want to be taken out of the game. So making something like this, a very, very high concentration position where you've got a big chunk of your investment capital tied up in it, is a ginormous mistake. Even back in the early days when they were posting up that really impressive revenue growth, they hadn't really shown that they could translate that into value for shareholders yet by that point. I get that they were gap positive for a minute, but the fact that they couldn't come up with, positive free cash flow for that year, and they never had positive free cash flow, that's such a red flag to me. So what I would say is, let me know in the comments below if you bought any Tattooed Chef. Let me know what you think if Warren Buffett is right that you should avoid investments that have a risk profile that could take you out of the game. Also, let me know what your riskiest investment is. So for me, I would say of the stocks I've currently got, it would be probably Palantir, just because, hey, they weren't quite gap profitable yet when I started selling puts, but they did have quite a few quarters running of positive free cash flow, only slight, but we made it a very small position, and that is the key. If you're going to take something of a chance on something that you see a lot of potential in, if it has the chance of either going really well or taking you out of the game, just make it very small, a very small portion. If you really, really believe that it has all that potential, you could still do really well if it's just a small position to begin with, if it takes off. All right? But if it doesn't, at least you haven't taken yourself out of the game. That's it, ladies and gentlemen. Have a wonderful Monday.